Good morning, everyone. June 22nd, 2022, joined with Tyler Tucci. How's it going, Tyler?
It's going all right. Better for me than for equity futures. That's for certain. We're Nasdaq futures down almost 2% this morning. That's good for about $5 on the triple Qs. So not a pretty soggy risk backdrop. We actually have bond yields lower, bond prices higher with lower equity prices for once. So that's kind of unique here. And we have, as we talked about yesterday, some weakness after some strength in oil this morning. We're taking a look below 105. As we mentioned yesterday, we were entering puts on green yesterday, and we're looking for a 4-month. We have a 4-week view on the components of really the oil services sector, if we had to pick one. But XLE in general, we have very, very flat to negative 4-week performance.
Yep, absolutely. And it's interesting that that's really starting to come to bear. So yesterday it was a great market day yesterday, right? Like everything was looking pretty good, except for Meta, right? Which is going through their own issues. But now today on the futures, it looks like I'm kind of buckling in for some strong headwinds today. Nothing is really looking good pre-market. Are you seeing any strength coming into pre-market today?
I mean, not really. The something interesting is, gold is flat, or was slightly green here, with the rest of the commodities complex significantly lower. We're beating up copper, we're beating up oil, but gold holding in is something that's been unique to this regime, or this part of the Fed tightening cycle, where forward inflation expectations are largely a function of will they, won't they. So sometimes, even though the Fed did tighten 75 basis points, you got some weakness. Because it's really about what does today mean for the future, not what does today mean for today. But in general, no, just like Foliko data has been putting out, still pretty bearish. As we discussed yesterday, we're looking for a FANG bottom sometime in October. We're not ready yet. If we get closer and we get some interesting earnings factor trades, maybe we'll do a little gambling into earning, but that's all it would be. We want to pick up our structural longs and our core large positions that we intend to hold. We think that'll be October will be a better time.
Well, I don't know if you saw, Tyler, but Jim Cramer just released a buy on Meta and is calling once again that company has bottomed out.
Well, victory's on the way for shorts.
Just like he did back when Meta was in the 200s. I don't know what his love affair with that company is, but he's got to be getting something on the side. I don't understand.
People like to talk about high flyers. That's really we could pump our subscribership by talking about Nvidia and Microsoft and Facebook all the time, but that's not
daily. We'll make this the tech channel.
Right, but that's not what we're modeling for. That's not what I'd say we're good at. We're good at a whole bunch of different things. Like we're going to dive into a little later. We have some interesting healthcare stuff to discuss.
Let's go right to it.
Okay.
Let's not even delay. Yeah. What are we seeing on the healthcare?
So I'm going to introduce this, and I'm going to just share my screen with everybody to kind of see how I think about, taking Foliko price projections and turning them into what am I going to do about this? Why do I care? Why does this matter? So we have some pretty negative performance actually across 1, 4, and 12 weeks. So what I did is I went to the XLV ETF, which is the healthcare ETF, and I just simply pulled the top ticker components.
Are you sharing? I'm not seeing a screen just yet.
Here it is.
Oh, there we go. Okay, it came in.
So a few things here. So in the C column, you'll see there are different colors. Those are my notes on the health factors. So we have some pretty ugly looking health factors. Overall here, I actually will point out one note. ABBV, my note was simply gross when I was looking at the health factors. So, not
zooming in on the sheet a little bit so we can get just deeper clarity on this. Yeah, there we go. Perfect.
Okay. So what I've done here is I've pulled. Sorry, showing you how the sausage is made. So what I did is I just simply pulled Foliko's view of 1 week, 4 week, and 12 weeks on the top components of the healthcare sector. What I did then was I went to basically as close to 3-month put prices as I could find. And I looked at what is the implied terminal break even, which in English is at expiry, how far of a move down do you need to break even? Obviously, the price profile changes between when you enter and when it expires, because there are obviously a bunch of factors, the time factor, all these other things. But I'm just looking at it purely from we think this, the market thinks this. So, we go to 12 weeks here, we see, we have UNH down 16, J&J down 12%, and PFE down 14% over the next 3 months. The options really aren't pricing that. They're pricing, UNH about 5.3%. And this is not the straddle. We're not trading vol. We're trading, we're taking a directional view. Before all you vol guys jump down my throat just using one side of the straddle here. But we're taking a directional view. I'm not saying vol is cheap. I'm saying downside is cheap to our model. There's a difference. So those would be the three I'd be picking on. Maybe a little ABBV, just to see. That's been a leader on the way up. It's been pretty much a rocket ship from, call it 80 or 90 to 150. So that would be another interesting one to pick on to see if you can catch the trend reversal, which we think is imminent. Honestly, I mean, we think, according to this data, we expect today's weakness in healthcare to continue and continue for the next 3 months.
So I'm seeing two at the top there, pharmaceuticals. Why pharmaceuticals looking bearish here?
Well, let's dive into it. If you want to take a look at, let's see, what is my favorite one? They both have pretty ugly health scores. So let's pick you pick one.
Let's go J&J.
Okay.
I was actually taking a look at J&J before, and I think there's an interesting story there. Let's see. Yeah, let me go ahead and share my screen. So I was taking a look at just overall. This is our view on healthcare sector. Now, what's interesting is if you compare all the companies in the healthcare sector with the market all up. So we see here the green line is the market just all up. That's the average of all of our coverage list, right? Orange is healthcare. Now, healthcare has actually slipped more than the market itself. Certainly not as much as tech has. But, that market, the market line is being held up by a lot of energy, manufacturing, basic materials types of tickers. Going forward, if you just look at healthcare all up, we actually see in Foliko healthcare catching up with the market or staying level while the market continues to decline slightly. But as soon as you start getting into some specific tickers, especially the big weights in the XLV, and I think XLV is in for some trouble because a lot of the tickers in that particular ETF have floated above a lot of the turmoil happening in the past 6 months. And we can take a look at that just for context here. But looking here at Johnson & Johnson, our algorithms coming in, seeing not a rosy picture for them. Health scores in general, fairly negative. And if you look here at their trend lines for the health scores, the 10-week, we saw some good strength late February, early March for Johnson & Johnson, right? And if you start comparing their earnings power health score, that 10-week, nope. Internet's killing.
Internet's trying to kill it this morning. Yeah.
Yeah. But the point being that for Johnson & Johnson, we did see strength coming out into mid-March, and that led to a good rally coming into April for Johnson & Johnson. And that's, XLV is so heavily weighted for J&J that I think breathed a lot of life into that spider, right? It's about what, 10% of XLV?
It's UNH, J&J, and PFE do most of the heavy lifting for that ETF.
But I was taking a look at we obviously COVID is a huge force in all of this, right? And COVID helped the stay-at-home stocks, so a lot of tech and a lot of healthcare. And so I was just curious. I pulled up both of these ETFs since 2020, and you see the pandemic effect happening there, right? So it's zeroing out here December 2019, and look at how tech just absolutely charged forward up till end of 2021, and then slipped and just got burned there. You still see some really nice appreciation in healthcare, not as much as tech. So I don't think there was as much air to let out of the tires on this one. But if you zoom in and just cover to the beginning of this year, that picture just absolutely goes opposite. And you start seeing healthcare down 8.3%. It's a pretty reasonable conclusion to say that healthcare has not suffered from this market in the way that tech has. And so the question is, given that healthcare and tech in the COVID era really appreciated, is there more pain to feel there? Look at this. April, again, this is matching that J&J shape. There was this really strong April rally. They were actually up for the year beginning April, until now they're really seeing that downward slope. Now, for a lot of those tickers, I was looking at them that was making up XLV. I see a lot of pain coming forward. Those pharmaceuticals, UNH, there's problems on the horizon. But you know what I'm not seeing? So if we go back to Foliko, right? Clearly on the sector view, if we go to healthcare, clearly on the sector view, there's a strength there that's actually outpacing the market in our projections. And where's that strength coming from? So if we take a look at where we see our 12-week prediction horizon, look at this. Look at the top 15 names.
Hello, biotech.
Hello, biotech. That's exactly it. That's the story, right? That's where the strength is. That's where the innovation is. And if you're looking at your pharmaceuticals, I'm not seeing really, again, yesterday, the question that we were talking about, I'm not seeing the narrative that goes with oil is going to charge up higher, right? That narrative is getting harder and harder to find. That biotech narrative, I think, is strong.
And I completely agree. And I think it's important to delineate. So maybe we'll look at next week, XBI, which is the biotech ETF. We're taking a specific view on the components of XLV. And by the way, AbbVie is somewhat of a biotech company, and we're still negative on that. So it's not like we're positive every single biotech stock, but we do see within a larger health concern sector, we would be long XBI, short XLV. And if you want to see something really gross, let me see if I can get this up for you. Let me see if I can share another screen here.
You're going to have to take down the screen you're currently sharing. Yeah. They only let us share one screen at a time. There we go.
So check this out. So this is what goes up must come down.
My goodness.
Abby, it led the rally. It was probably one of the best performers. Out of COVID, from 100 to 170 or something like that. Just a massive move, and it was incredibly underpriced. I mean, it was down at 75 with a massive dividend, and everyone just completely missed it. But we are trying to hunt it a little bit on the short side here. We'll continue to monitor what has been a pretty nasty green to red in terms of these longer term health factors here. This very much suggests that the best is behind them, at least for now. And I just want to highlight this because this is the power of Foliko, right? We can quickly delineate between the good and the bad biotech stocks. Within a sector, we can really distill down what exactly we want to have a view on, which I think is important. If you're long the biotech ETF, but you only really like two names in the ETF, you should just be long those two names in the ETF and vice versa. So, this is something that we'll focus on in terms of, really doing a good job having the exact exposure that we have a view on. And that may sound simple, but it's actually, I've seen it made quite complicated. So, we'll continue to look at it in this manner.
So all right, whenever you see a health score picture like that, we've got to bring out our health score comps model.
Yep.
Right. Like, so, all right, I've pulled up AbbVie while you were showing that health score range there. Look at what we're seeing here. So now, again, for those that missed the broadcast yesterday, in this orange line, all right, you want to be above this red dotted line here. That's going to show some strength. And this is a risk factor model that we have coming in that's comparing health scores across all the companies. We have 3.8 million data points here, and we're taking the 1,000 closest data points to where this ticker is right now. And we're saying, out of those 1,000 data points, what did we see happening? What was the evolution of those companies when this data came out? And so for AbbVie, what we're seeing right now on the 10-week, so there's actually a little bit more strength on the 10-week in the way that its patterns are going. I think that the shape of that slope, you see how steep that was coming into now, and then it was starting to recover a little bit, right? And so that 10-week actually shows a little bit more strength, but still heavy downside, at least till July. If you look at all up, though, in its current health scores, and you combining that with the majority of our other factors, I'm not really seeing a lot of positive for AbbVie in the near term. We're looking at a market neutral rating somewhere early September. And I mean, really nothing much to hope for after that. If we come in and we look at Johnson & Johnson, it'll take about 10 seconds. So what do you pull out of that, Tyler, if we see the shape of that?
I mean, it just makes sense that forward returns are pretty much stuffed for this thing after doubling. I mean, that might be the dumbest thing I say on this broadcast this morning, but that's just the facts, right? Like, when you have a move like that, you need at least consolidation, if not, some check back lower. That doesn't mean long term it's not a hold, but we certainly would be, we would be selling longs, we would be looking to get short, or if you don't like to do either, we would just be watching for better prices. Especially this thing was a dividend stock. So, rates may continue to play a role here. You may be able to scoop it up, cheap again with a, 5 or 6%. Well, actually it'd have to be a bit higher. It was 5 or 6% back then, but, a significant yield on a biotech stock, which, is I think with the way the next 10 years are going to look in terms of health innovation is a pretty good bet. But yeah, I mean,
Well, contrasting that with Johnson & Johnson, right? Just coming in, and I'm going to reference the spreadsheet you were sharing earlier. We're in Foliko, we're seeing a lot of problems and weakness over the next few months, right? And then, and that's exactly what our health score models are showing. This dip right here is a pretty significant dip for Johnson & Johnson, and that's probably where we're going to see the meeting of the targets you've been talking about. So yeah, go ahead and pull that back out.
Okay.
So our 12-week down 12%, but you'll notice we're achieving most of that downside there in just the next 1 month, right?
Right.
And that's exactly what this health score model is looking at again. Now, remember, this health score comps model works in an entirely separate fashion from our standard stock price prediction models. So what you're getting there is different views at the same output, right? I think when they're agreeing like this is a signal to me. A lot of those top tickers in XLV, I'm seeing weakness in it. You do the same with UNH, and it's going to come out with a similar picture.
And I think it's important to put in context. Why did we look at XLV in the first place? Well, we were talking, and we said, okay, you look at how a bear market works. The first leg of it, we shoot all the growth stocks. Those all get derated, sent lower. The ARC portfolio in general, right? We way off the highs. Step 2 is you kind of get the intermediate stuff, your FANGs, your Microsofts, your things that your 401k investors have just kind of been using as a cash substitute for a while. That's on the way. And then step 3, you throw the baby out with the bathwater. So that means stuff that, the current situation, if anything, is, at the margin positive for healthcare, right? The macro situation. But that's going to have nothing to do with the fact that, you're just going to have to sell the winners now. Like, that's what happens at the end. All the winners, all the higher quality stocks. You've seen it recently with utilities, which also are interest rate sensitive. So, you could argue with me that they're just catching up to the rate move, and I probably would concede at least in part to you. But yeah, to what you pointed out before, tech came off, and healthcare stocks didn't, and some of the higher quality stuff didn't. And that's what I think we're sniffing out with energy. We want to be short energy. We want to be short healthcare. I think Foliko is picking up the third leg of the bear market, because that would make sense. We have, 60 to 90 days of pretty much, a soggy risk backdrop. XLE is ugly. Healthcare will be ugly. I don't have to tell you how we feel about semis. And that will give us, that kind of thing. If we wash everything out, will give us an intermediate bottom where you can start to accumulate, not for just a trade anymore. Because that's in my view, the next 2 to 3 months should be stipulated with, but it's for a trade. There are a couple names like Rite Aid we mentioned yesterday. We have 40% upside. We think he can hold that. But generally speaking, you're in for a trade. Yesterday we didn't get in because it gapped up too much, but we were in Valero for a trade. It was just simply an options flip. We were not taking a longer view. The longer views we think are kind of October until the end of the year. And we're going to see these higher quality, sectors kind of lead us lower and really help finish this bleed out.
So does that mean that we could start to see a full market bottom as soon as those legs are hitting?
I mean, generally speaking, if we go back to 2018, for example, which is a completely different experience because we packed a year and a half's worth of pain into about 12 days. It was absolute seasons beatings. But it ended, I believe, XLU and the higher quality stuff was the last to go. I think it was on, in fact, Christmas Eve day, because the day after the Secretary of Treasury had a call with all the bank heads, and it was like, plunge protection team assemble, and we bottomed right out of there. But yeah, that was the higher quality utilities. I just remember utilities because I was short them. But that was the last leg of lower, and I didn't even get really much of a rate move with it. So it just kind of was just the last leg to kick over. So I think that's where I'm drawing my thesis from is if we're going to finish knocking the stool over, we have to kick the last couple legs out. Healthcare, energy, things like that, and Foliko very much agrees.
So Tyler, if I can start summing up as we're wrapping up here, I got to get out and start trading, placing some things before the market opens. What we're seeing in healthcare is not necessarily weakness across the board. There's pockets of strength, pockets of innovation, but those standard names that have kept XLV up higher, we're seeing weakness specifically there. Yes. And so for that ETF in particular, we're seeing troubled times ahead, but not necessarily for the whole sector. Is that about right?
Yes. When we're picking on healthcare, we do think you can short XLV because the weighting of the components that we think will underperform is high enough to bring it lower. But it's XLV and pretty much the names I listed. There are a couple other high flyers that have some downside. But we're focusing here. Maybe next week we'll do some biotech names and kind of show the other side of, but we are pretty freaking bullish on, some names, and I think we have some pretty good reason to be. But yeah, it's these here. It's XLV, UNH, J&J, PFE, and ABBV. If I had to, if it had to be, trade 5 names only over our forecast period, I'm thinking it would be those. Some people can't trade single names, so the XLV ETF will work just fine here. We have enough of a view on enough of the weightings that shouldn't be a problem.
Makes sense. All right, for everyone joining us, thank you very much, and we'll talk to you more tomorrow, 8:30 a.m. We'll be back.
See you tomorrow.